Good afternoon, guys. My name is Robby Pietropaolo, otherwise known as Robby P. I'm a private client trader at Vunani Private Clients, and I'd like to welcome you all to the JSE webinar, where today we're going to be talking about how stop losses are used, and this is an introduction to stop losses. They're not merely a part of trading that you lose money in. They're also a very, very important part of the whole trading strategy. So I'm just going to talk you through the various ways that stop losses are used, how you can implement them in your trading strategy, and as Murphy would have it, today is actually a great day to talk about stop losses, given the fact that the Aussie gave up almost 1,000 points today. So without any further ado, let's keep calm and learn how to use a stop loss. Right, so first of all, let's define a stop loss. Now, a stop loss is an order placed to close a trade on a security when it reaches a certain price. A stop loss order is designed to limit the investor's loss on a position in a security. Although most investors associate a stop loss order only with a long position, it can also be used to cut a short position, in which case the security would then be bought if the trade trades above a certain level. So here we can see an order ticket. There's a market order. This is a currency pair where you put your amount in at best price and the stop loss is included in the order. A lot of platforms allow you to put your stop loss and take profits in at the same time, and others don't. But this is just a typical example of what you should do when you're placing an order. As you can see, a stop loss is a vital part of any trading strategy, but we'll get onto that now. Okay, so why use a stop loss? A stop loss order takes the emotion out of trading decisions, which is very important because the market is ruled by fear and greed. And as a trader on the desk, I know that my clients typically tend to panic right at the bottom. So they normally get out when it's either far too late and they end up losing a little bit more than they should. Okay, so a stop loss is especially handy when you're on holiday or you can't watch your position. It's better just to have a contingency plan or a contingent order in the market, so that if things go wrong while you're not watching or unable to watch, you know that your money is protected. And as I said, a stop loss is a vital part of the trading plan. Every trade must have a planned entry, a planned profit target, and a planned stop loss if the trade goes wrong. It's part of the whole trade. It's not just something that needs to be put in after the fact. It must be part of your strategy. Okay, so here we have a nice picture of a trade idea which we sent out the other day. We went short Trueworths at 73 Rand 87, and as you can see here, we stipulate our profit target, but we also have a stop loss zone. Now, the stop loss zone in the case of this trade was if the trade trades between 80 Rand 50 and 81 Rand, we want to get out within that zone. So there you can see, as part of the trading plan, our potential profit was going to be 13 bucks and our downside risk was 6, with a risk to reward ratio of 2. Okay, we took that trade out a little bit early the other day as it went to 69 Rand. It was a very quick profit. We ended up only making about 60% on the trade, but the whole point of this order ticket is to show you that the stop loss is most definitely part of the trading idea and part of the whole trade. Okay, now the danger about having stop losses, and this is something you guys need to realize as well, is that it's all good and well having a stop loss in the market, but you need to be aware of the fact that if your broker gives you a trading platform that has direct market access, prices can gap through your stop loss. So execution is not guaranteed, particularly in situation where there's an event overnight and stock prices either gap up or gap down with market uncertainty. There's a very real danger of this happening to you. So I've said here, mind the gap. This is actually a gold chart on GLD, which I've zoomed in on the candlesticks, and this is kind of the danger I want to point out. So let's say, for example, you were in the trade around this level, you were trading within these candlesticks, and your stop loss was somewhere in this gap, and the next morning the market opened way down here. That physically means that your stop loss order would not even have triggered, let alone traded. And the only time that stop loss will trigger or trade is when the trade trades back up towards you. So missing your stop loss is very real. So you guys have to monitor your stop loss levels, and especially when there's a lot of turmoil or uncertainty, you know, when maybe you're expecting a big announcement out of the US or Europe, or there might be the potential threats of war, geopolitical risk. Make sure that you're aware, and don't shout at your broker if your stop loss is missed, because this is very real. People have gapped through stop losses on many, many occasions. So now I just want to talk about pulling the handbrake on a bad trade. The stop loss has quite a few uses, and I'm just going to walk through the basic principles and a couple of basic stop loss strategies for you. So we're going to discuss the percentage stop loss. We'll also look at some patterns. How do you put a stop loss when trading patterns? Support and resistance, probably the most effective and most successful way of avoiding to lose money. Also the volatility stop loss, very important. Guys often get in and out at exactly the wrong time. And then a time stop, also very important, because trades end up costing you money if you hold them too long. So let's take a look at some of these. So first of all, where you place your stop loss all depends on your appetite for risk. Some guys are risk averse and prefer to have stop losses a little bit tighter, where other guys are a bit more aggressive. Give the price a little bit of time to run away from him, not panic a little bit, maybe take an average. He's got a bigger appetite for risk and is willing to watch a position drift a little bit further out of the money than somebody else. But the bottom line is that you know yourself better than anybody else. So you need to identify how much risk you're prepared to take and where you're going to take your bloody nose if the trade goes against you. So the percentage stop loss, quite basic. This is where a trader will place a stop loss a certain percentage away from the entry point according to their risk tolerance. So what I'm saying really, as an example, if a trader enters a trade looking for a 5% move on a stock and the share price decides to drop 2%, or he decides that if the share price drops 2% from his entry, he wants to be out of the trade. Plain and simple, it's all in percentages. He wants to make 5. If he was trading a single stock future or ECFD with a little bit of gearing, you know, it relates to about a 50% move to the upside if he was 10 times geared, and a 20% loss on the margin that he used at 10 times gearing. So percentages are a nice way of just keeping it nice and tidy. Now a lot of technical guys like to trade patterns, and patterns are quite a nice way of knowing the area of where to place your stop loss. Technical traders look at charts and patterns that develop out of price action, and they would typically place a stop loss level that would either break or change the pattern. So without getting too technical, as this is an introduction, I just want to look at some basic patterns, and maybe you guys can look at your charts, see if you can identify any of them, and this will help you not only establish where to put a stop loss, but help you to formulate a complete trade. In other words, your entry, your exit, both take profit and stop loss. So let's look at some basic patterns. Okay, one of the most common ones is a symmetrical triangle. Very nice to trade and also very easy to place stop losses. So as you can see, the symmetry is formed by these two lines of support and resistance. If you were trading a symmetrical triangle, generally this is quite a bullish continuation pattern. So traders would generally look to buy a break above or below this triangle. In this case, the price broke up above the triangle, and traders would have generally gotten in after confirmation, which would have been probably this green candle over here. Now, once you've established your entry point and your take profit, how will you know when this changes? So what a technical trader trading this pattern would look for is that the price breaks back inside the triangle. Because once the price breaks back inside the triangle, chances are, high probability, that it would go and retest the bottom of this triangle, which would then trigger either a short trade when it breaks out of the triangle, or a long trade if it bounces off this line. So if you traded this green candle on a break of the symmetrical triangle, quite easily you would place your stop loss somewhere in this region, which is nice and tight, and it tells you exactly what is going to happen when you go wrong. So you would have typically bought this at, say, 17.40. If it broke below this line, you would have taken it out near these, or just underneath these lows at, say, 16.75. You would have lost less than a buck and taken all the upside. Does that make sense? Here we have a flat top triangle, pretty similar to the symmetrical triangle. Quite a lot of trades possible trades going on in here. Two examples I can give you just by looking at this chart. Well, first of all, here we have the flat top. There we have a break of the flat top. And here is a nice stop showing that if you bought the bottom in this congestion point, a bounce off the support line again, as with the symmetrical triangle before, you'd be buying a bounce off this bottom, maybe taking profit here if you're a little bit conservative, but then break traders would typically buy the break out of this flat top triangle and then look for a lot more upside. For them, it's quite easy because once they've traded the break, they would place their stop loss back inside the triangle as with the symmetrical triangle. But if you had gotten long in this area of congestion at this flat top triangle, you would have placed your stop outside the triangle. So the minute it broke out and confirmed with maybe one more trading session below this support line, you would have gotten out and saved yourself a lot of heartache. Here we have what I like to call the megaphone pattern or a broadening formation. Now these can also go either way, but generally this is a bearish pattern. It signals that there's a big price move going to come to the downside. This is a bearish continuation pattern in general. So very easy. If you look at the other two triangles, this one faces the other way, and you would typically wait for a break of the support line. You would enter a short trade. Obviously have your own target in mind up to your risk tolerance, and as with the other two triangles that I've shown you, any break back into this rising megaphone or broadening formation would be your stop loss. So let's say we would have gone short at a break here, so let's call it about 43. We would have looked to go short and held that short into the money up until we're comfortable with the profits that we were going to make. But any break back into this triangle would have left you massive upside to carry. Okay, now early traders, as you can see here, would have gotten in at the top of this megaphone formation. So another trade, so there's two in one here that you can look at, because many trading opportunities in a broadening formation. You would get short at the top of the broadening formation, take profit around this level. If it breaks out, you could get short again. Quite a nice pattern to trade. And the famous head and shoulders. Now a lot of guys trade the head and shoulders completely the wrong way. What many guys don't realize and don't understand is that a head and shoulders, whether it's upright or inverted, upside down, always retest this neckline. So let's just go through the parts of a head and shoulders. You'll always have a left shoulder. You'll always have a higher peak which forms the head, and you'll always have a right shoulder. The right shoulder for a continuation bearish pattern is generally weaker. In other words, you'll have far more red candles on the way down. Now when a head and shoulders pattern or the price breaks through the neckline, this is not your signal to short. Your signal to short would be this candlestick over here where it retests the neckline, because a lot of times these patterns fail if the neckline isn't broken and retested. The neckline has to break or has to be tested and fail. Once it breaks above the neckline, the pattern has failed, and this is what makes it nice for placing a stop loss. So once you've identified your head and shoulders pattern, you wouldn't be going short over here on the break, and you wouldn't be going short on the confirmation. You'd be waiting to go short on a test of the neckline and a failure. In other words, we'd be going short here at this black candle. You need to confirm. Then trading this pattern becomes very easy, because the rules of a head and shoulders says that the distance between the head and the neckline should equal the target to the downside. So there's a lot of downside. Even though you've missed 2 or 3 candles on the break, you've still got a lot of downside to make profit. But let's say you've entered the trade now and you're not sure where to put your stop loss. Now remember, the head and shoulders always test the neckline. We could have seen a second test over here, so your stop loss should not be the neckline. it should be a break of the neckline. So typically a technical trader would have placed his stop loss probably a little bit to the top of the last candle that broke that. So you'd place it maybe a buck or two or three above that neckline, and a close above that neckline really confirms that the head and shoulder has failed and you should be out of the trade. So these patterns are very nice to trade. Support and resistance, probably the easiest way to trade. You'll probably stop out more times than you like, but the upside or the gains are far more consistent. So quite typically a support and resistance trade, obviously where a price struggles to make new highs is known as resistance, and where a price seems to find buyers is known as support. And now we can see 1, 2, 3, 4, 5, call it 5 or 6 areas of support on this chart specifically, and let's call it 3 areas of resistance on this price. So again, we've got 2 typical trades here that we can trade. If you had gone short on the resistance over here, you would have typically maybe shorted one of these 2 candles. There's one of those gaps I was telling you about. If you were short, you wouldn't mind a gap because you're far more in the money than you were the day before, and you can trade all the way to the support line and take profit. Now, where would you have placed your stop? Very easily, a break similar to this candle. You would have placed your stop loss well outside that resistance line if you were short, and buy your short back if the trade went against you over here. And then you get the other trader, which is the break trader, who would not be buying in this area. He'd be waiting for a break of the support level. So these 2 candles over here don't signal a break just yet because they managed to close more or less on that line of support. Your first hint was this candlestick over here, where you might have gone short. This one definitely confirms it. Now, this is exactly what I was talking about earlier. You would have gone short over here. You would have had a target somewhere down here, and you would have placed your, if you had placed your stop on that support line, which now becomes resistance, you would have been stopped out, and you had gone short again, you would have been stopped out again. So make sure that when you trade support and resistance, you actually get a break and a confirmation. Now, a nice little trick to this, is which I like to use myself, is I like to use closing price stops. So let's say my stop loss was over here at 45 Rand 90. The fact that, and I was going short, and the fact that this price traded through 45 Rand 90 3 times or 4 times would not have concerned me. What would have concerned me is a closing price above 45 Rand 90. So I would have looked at this price and said, look, if it's closed at 46 Rand or 46 Rand 10, it means that support is now held and back in place. I would have then stopped out of this trade. So a closing stop is also quite a nice strategy, because then you don't stop out for no reason. The problem though with closing stops is tomorrow morning you might find yourself stuck in a gap, which I spoke about earlier. Here's another most common support and resistance, because they're not always horizontal or parallel. Here's a nice trending support and resistance. Here's your resistance line, and there's your supporting bottoms. Now these patterns are quite nice to trade until they change. So what you'd be looking for here is every test of resistance you'd be looking to go short or take profit if you were long. Now, how do you trade this with a stop loss? Marked on this chart are the areas of support. So not all of them are on this support line, but most of them are. So I typically would not be getting in over here, but I definitely, on the bounces, I'd be going short because the trend is down. So these would be my take profit levels unless the trade breaks out of this trend. You could have shorted this kind of pattern every single time it tests the top. And looking at a lot of the stocks on the J200 at the moment, there's quite a few retailers that are looking at similar patterns, and Kumba is actually one of the big ones that's had a multi-year pattern like this. So you could have typically shorted every single bounce on that kind of stock, taken profit. But as you can see, any break of this resistance line would have stopped you out. There's no need for you to ride a stop past that, because you can see the broader trend is down. So this would be a great short trade every single time. take profit, wait for the bounce, get short, take profit, wait for the bounce, get short, and placing a stop loss, as you can see on a downward trend, is always going to be lower. So if your first stop loss was up here at 23, by the time you've traded this 3 or 4 times, your next stop loss is only going to be at 19.5 or 20, but you can still ride this trend all the way down until it changes. Once you've hit your stop loss, you'll probably find it's time to go long and that the trend has changed, and then everything changes again. Here we have an upward trend. So I've marked on this chart here your buy zones. Okay, here is a nice example of where you would have stopped out on an upward trend. So we would have probably bought it around here somewhere, and the very next day it closed below the upward trend. We would have triggered our stop loss. Now, we wouldn't have climbed back in again, and we would have probably missed all of this upside. But then we get a retest of this trend line, where you look for, does it get support here? Yes, it does. We would have gotten in somewhere in between this candle and this candle. I would have probably gotten in halfway through here, because this has showed me that it's closed above the support line. Remember, this is a closing price. So we could have ridden this. We probably would have missed a greedy target. Conservatively, we could have still made money, but even if we didn't bank it, we could have ridden this trade all the way up to the ultimate goal. In this trade, particularly Aussie dollar, US dollar, at that stage had a 1-to-3 risk to reward ratio. But as you can see, just because intraday price action breaches your support line, not once did this currency pair close below the support line. So it's very, very easy for you to place your stop outside the support line, wait for it to close there, get your confirmation, and you're out. So trading patterns is a very nice way and a visual way to place your stops. Right, volatility. Volatility is what day traders dream about. This is where they make and lose lots of money. But it's also where short-term to medium-term traders often misstep or get stopped out prematurely, because they tend to trade volatile stocks and they're not sure where to place their stop loss. So if you took a stock like Naspers, for example, and you went long a couple of days ago, you would have enjoyed a 60 Rand move, but then a day later you would have probably not enjoyed a 35 to 40 Rand drop on that stock. And you probably would have been stopped out if you had a stop loss that was too tight. And too tight is probably understating what I'm trying to say, because on a stock that's volatile, how would you know where to place your stop loss? And can you handle the big price moves? So a lot of traders often think, well, I'm going to put my stop loss 30 Rand away on a stock like Naspers, where 30 Rand actually means nothing to that stock, and you would have stopped out for no reason, only to find that stock jump up another 40 Rand again a couple of days later. So volatility is one of the main contributing factors for stopping out too early. Short-term traders rely on volatility to make money, so that they are able to scalp small price moves. It makes sense then that having a stop loss on a very volatile security that has big swings makes no sense at all. So you need to have guts, and you need to identify the volatile stocks. And I've got a little thing that I want to show you now just to help you out on how to identify volatile stocks. A nice indicator, if you guys have got a charting package or software, it's a very nice indicator to add to your technical analysis. You use the Bollinger Band. So having evolved from the concept of trading bands, Bollinger Bands can be used to measure the highness or lowness of a price relative to previous price action. Okay, so all this really means is it takes all the highs and puts a band at the average high price, and it takes all the lows and it puts a band near all the low prices, so that you got an average. It also has a line right down the middle, and it's generally a 21-day moving average. Okay, and how to read a Bollinger Band, but I will show you. But an explanation is, when the bands lie close together, you have a period of low volatility. Okay, when the bands expand and they get further apart, there's an increase in price action, and market volatility is what is being indicated. So the further away these bands get from each other, the more volatile it means that share price or that security price has become. Okay, so when bands only have a slight slope and track approximately parallel. And parallel doesn't have to be a straight line. I'll show you on a chart in a bit. It means that there's a period of normalcy or normal trading, and you could probably end up trading ranges or trading the channel. Okay, but let's have a simple look at Bollinger Bands. This is just a nice visual on the Dow Jones, and this shows you kind of what Bollinger Bands are supposed to do for you. So in the middle here, you generally have your 21-day moving average, and prices tend towards and away from it. Okay, so here the upper band measures all the highs. As you can see, the highs always tend to go towards the higher band, and the lower band kind of measures all the lows, is what I was telling you about. And the midpoint over here generally should be where the price is trading. Okay, now how to read this. So let's start from high volatility. Here you can see the big difference in the space between the upper and the lower Bollinger Band. Okay, this tells you quite easily how volatile this period of trading was. Okay, and a lot of traders would be stopped out in a period like this unless they've got the guts to stay in and realize that there is volatility and they need to stick it out. Okay, most guys like to, or the more cautious trader would like to trade in periods of low volatility. So the Bollinger Band gives you a nice visual to get in and out of trades. You typically like to get in the midpoint, trade up to the top band. If it goes to the bottom band, you stop out. Or if you had gone short on this trade, you'd have taken profit here, stopped out on the top band. Nice and easy to trade. But then you can see it started widening again. The price kind of stayed stagnant for a while. Then the volatility started kicking in until we went to a medium volatility. And remember, I said medium volatility is where the Bollinger Bands kind of parallel track each other. So instead of bulging out like this, they start to form a bit of a track or a train track that becomes nice and easy to trade. So you can even see the direction over here is sloping down. So whenever the price touches the top Bollinger Band, you could probably look at placing a short trade and waiting for it to either get to the midpoint to take profit, or wait for it to retest, if you're really greedy, retest the bottom Bollinger Band to maximize your profits, but very easy to place a stop loss just outside the Bollinger Band. Okay, so any charting package should give you the ability to place Bollinger Bands. A lot of traders use them successfully, and a very nice indicator of how volatile a stock is. Now, if we were trading NASPAS, for example, these bands would be bulging like this everywhere. So you need to identify volatility, identify low volatility, identify medium volatility, and trade within that so that you don't stop out for no reason. And then the time stop. I know it's very difficult for a lot of traders to close a trade because every trade is emotional and everyone has such great potential. But derivatives traders know that trading securities that rely on gearing, like single stock futures and ECFDs, carry finance costs, guys. You're putting down a deposit and the rest of that deal gets financed by a bank. Okay, now you guys are paying interest on that for overnight carry, and that gets marked to your account. You get billed. Now if you carry a stock for far too long, these costs end up costing you any profit that you might have made, because you're funding roughly at about 7% per annum. So you really need that stock to recover 7% before you've even made that interest back. So clearly carrying a stock for too long costs money. But more importantly, guys, having your money tied up in a bad trade or a trade that's going nowhere slowly has opportunity cost. So you need to just cut the losers or cut the trades that aren't performing, place the stop loss, and get out if this trade moves any further against you so that you can use that cash for a better opportunity. I often get asked about a trailing stop loss. Now, not many platforms provide the ability to track it, and a lot of guys make errors in placing the percentages on the trail. But first of all, let's explain what a trailing stop loss is. So this is an order that's adjusted as your trade moves in your favor. So this does not have to be automated. Guys, you can monitor your position, you can get greedy and just move your stop loss a little bit closer every single time. So as the trade moves in your favor, you just place your stop loss in your favor. And generally, a trailing stop your starting point would be at the price you entered the trade anyway. So if you get a nice run or a nice rally in your trade, you can place your first trail at the point of entry. That way, the only thing you're going to lose is your brokerage fee. And as the trade moves in, you can lock in profits, lock in profits, lock in profits, while letting your trade run a little bit more. Okay, so it is a nice way to get greedy with at the same time locking in your profits and not losing money or taking a physical loss as a stop loss. So these are known as profit stops as well. Guys, I hope that gives you a little bit of insight. I'd like to thank you, Robby P from Vunani Private Clients. Thanks for listening.